Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, the day after the interim budget, which was just that, an interim budget. A hand-holding kind of a budget till, of course, the big one in July. We are coming to you from the CNBC TV18 studios. I'm Prashant. With me, my colleagues, Sonia and Nigel. Guys, hi, morning.
Hi, good morning. I don't know how the energy levels are, but after that long day yesterday, I'm just, waiting. Thank God it's Friday. But as you said, I mean, the budget is now behind us and the market is going to move on, and several cues to track as we begin the day.
Well, that's right. And with earnings season as well as the budget, normally this is that 1 week in the year when you're really pooped out by the end of it. So looking forward to the weekend. But we've got Friday, which has interesting factors that will play out as well.
Yeah.
Absolutely. And earnings in the US, big tech earnings in the US, I think that should dominate as well. So let's just quickly run you through, as we begin the day, a few things that you need to know as we begin today's session. The Nifty yesterday, by the way, budget days usually are volatile, big swings. Yesterday was not that. And I think, absolutely on the point reaction to the on the point budget. The budget did not have very much. I mean, no changes in taxation. I mean, that's where bulk of the big surprises, downside, upside, etc. comes through. But there was none of that. And the market was well behaved. I mean, 50, 60 points higher at one point, then cooled off, and we finally ended about 30 points higher. But, we did recover. The US, by the way, which had sold off the day before, overnight has recovered a little bit, about 1.25% of that sell-off after the FOMC. So, flattish yesterday for us, but we are coming back with a more positive and constructive picture from the US. Now, the S&P, as I said, was up about 1.25%, NASDAQ 1.3%. The 10-year is now down, in the US, is now down to 3.87%. I mean, that's a far cry from where we were even about 6 or 7 days back. And of course, I mean, from those 5% levels, this is the second swing down that we've seen. We had a fall from 5% to under 4%, then a pullback all the way to about 4.3-ish levels, and now we are back under 4% once again. Dollar index, it's sold off to near 103 levels. So broadly, this is exactly what you want to see. And it's not as if growth in the US is at the margin the reason why yields are falling and the dollar is weakening. Because, I mean, you had the ISM manufacturing numbers, etc., which were pretty good. Now, big tech earnings is the other factor. So, markets were rallying in anticipation of good numbers from companies like, Amazon, Meta, which is Facebook, and there was, of course, Apple, which reported post-market hours as well. And at the margin, I mean, numbers actually across the board from all the three big tech names in the US are okay. I mean, actually are good, are better than expected. Apple, maybe after hours, reaction is a little subdued. It's down about 2.5% the last I checked with regards to some iPhone commentary, etc. Microsoft, which reported 2 days back, that also is indicating a pretty good sort of, outlook out there. So the odd man out in terms of the big tech which we've got so far is really Google. Google is, of course, the big one where the advertising revenues have not looked up. But otherwise, I mean, big tech, which is such a big driver for US market, seems to be in pretty good shape. Oil prices down 3.5%. We're back at about just under $79 a barrel. Just a few levels on the Nifty. We need to take out the gap area when the market starts to move higher, because, I mean, the budget is behind. We'll kind of trade off some of these other cues that I mentioned. We need to take out the gap area of between 21,851, which is the lower end of the gap area, and 21,970. And support comes in at at around 21,450, which is nothing but, I mean, the lower end of this range. It's a 300-point range, 21,450 to 21,750. So, I mean, if you get the prices back around the 21,450 kind of levels, it gives you a great risk reward. For the Nifty Bank, the 40-day exponential moving average is 46,363. And then after that, we look at 46,567 on the upside. Very near term, I mean, on the Nifty Bank, support should come in. And the Bank Nifty should not break 45,670. The stronger part of the Nifty Bank, of course, is not private banks. It's public sector banks where you've got support from, of course, lower bond yields, mark-to-market gains yesterday, and, of course, earnings after the third quarter should see bump up for the full year as far as PSU banks are concerned. The Gift Nifty is implying an open right at these gap area levels, 158 points in the green. Sonia.
Oh, absolutely. It's a big morning that we're staring at, right? 158 points in the green for the Gift Nifty. So the big question that we're asking is this market all set for a pre-election rally? I mean, that's the question that we're posing to everyone. So let's see how things play out from here. But there are a couple of data points which indicate that this market perhaps is all set for that breakout on the upside. if you look at what happened in the budget yesterday, the government pretty much ticked all the boxes on the macro front at least. The fiscal consolidation pathway is pretty much intact. The government has raised its FY24 gross tax receipt forecast as well. And the government is now focusing on better spending quality. So if you look at the revenue expenditure growth, it's just 3.2% on a year-on-year basis. Now, there are also signs that the economy is picking up, even the rural economy, which was struggling for a while. So if you look at the two-wheeler sales, for example, right, except a Royal Enfield, which is in the premium segment, all other two-wheeler companies have reported between 23 and 25% growth in the month of January. Whether it's TVS, Bajaj Auto, Hero MotoCorp, etc., a sign that perhaps a rural market is starting to recover now. Apart from that, the government's focus, as we saw in the budget yesterday, is largely on tourism. And those stocks are definitely going to once again come back on the radar. Indian Hotels could be one of the stocks in focus today. It reported its best ever quarter in the company's history. And that is a stock that has been performing very well. So don't lose sight of that. Also, because this market has taken the budget with both hands, a lot of positives in the budget from a macro standpoint. I would keep the PSU banks also on your radar. So tomorrow you have SBI's numbers coming through, and there was a rally in PSU banks yesterday, even in the middle of the budget speech. So keep an eye out on that. SBI is at about 650 rupees right now. So let's see how that plays out. But a couple of these pockets are standing out, and it's a big opening for the market today. Let's see if that pre-election rally is something that plays out. But for now, things are looking good.
Well, that's right. On the budget, what you like is the fiscal prudence. So that's good news. And overnight, the troika, so to call it, has been well behaved. The 10-year yields, you had crude oil prices as well, and the dollar index. So no worries on that front. It's setting us up for a perfect Friday, actually. And what do the FIs do? Well, what they have been doing in the last few sessions, they added some mile-long positions and they covered some shorts. And that's what takes the shorts down to sub that 70% odd mark for the first time in this series. In fact, at the start of the series, we said, don't be too worried if the FIs are net short. 108 contracts on the 108,000 contracts on the short side was what it was positioned at. That's come down to around 80,000 contracts, which tells you that's a 28,000 contract move out there. And the net short positions have come down drastically. Then it appears, looking at the options data, there's a short straddle at play. What is that? The same strike, 21,700, call as well as put. You couple the premium between them. It's close to around 350 rupees out there. Just add both those two premiums. It appears there's a short straddle at play. So as of now, if there is a short straddle at play, you take 21,700, deduct 350 points, and you add 350 points. So you're getting that broad range. If that strategy is at play, then on the downside, 21,350. On the upside, you don't expect it to cross the 22,050 yards. So that's what the options data is suggesting. Well, the Nifty levels you're looking at in the near term, yes, we're going to be starting gap up, but you don't want the 20 DMA to move out. And we've seen numerous times we go closer to around the 21,100, 21,200, which incidentally is where the 50 DMA is at. And from there, you've seen a bit of a bounce. So that's about the Nifty in terms of support levels. The Nifty Bank, that's been the star outperformer this week. And we had highlighted this earlier this week as well, that the Nifty Bank, yes, it had a torrid run in the month of January, but towards the end, it was showing signs of relative outperformance. Case in point, on the day when the Nifty fell down closer around 200 points, you had the Nifty Bank that was more or less stable. So if you just pull up the last 1 week chart, you'll see that the Nifty Bank is up closer around 3% in this week. And after a while, in a single week, you have the Nifty Bank actually that's outperforming the Nifty. The levels that you'll be tracking from here on the upside, you'll want it to get a little bit higher, get to around the 20 DMA, get it to around the 50 DMA, which is close to around 350, 400 points away from these levels. If that's the case, the Nifty Bank will have some bit of its mojo back, and maybe it can drive the Nifty higher as well. But those are the important points I'm looking at. And the big Q tomorrow is going to be SBI, so there'll be some pre-positioning today. SBI, remember, it's closer to the 52-week high. It's seen a bit of a bounce. It's been quite strong as well. So let's see how that goes. But that's going to be the big Q coming in for the weekend. For starters, Gift Nifty suggests a big gap up, but you'll want it to build on from here on. If you're trailing with a stop loss, 20 DMA is a crucial one we're looking at on the downside. All
right. And we also have other big heavyweights like Tata Motors that will be announcing their numbers later today. So it's an action-packed day that we have lined up for you. In the next 2.5 hours, you'll get to hear a lot of opinion coming in from experts. So let's kickstart the show very quickly. On the equities front, first up, we have Ridhim Desai of Morgan Stanley, who says that the interim budget is neutral to slightly positive for equities. He says the higher than expected fiscal consolidation is good news for macro stability, but at the margin, a slight drag on earnings. That said, he adds likely lower long-term yields augurs well for equities. He says the lower government borrowing for the rest of this fiscal and next year is good for liquidity and the private sector banks, and adds that they are overweight on financials.
All right, Amit Sachdeva of HSBC says that the interim budget presented fiscal consolidation along with a thrust on capital expenditure. He says the budget retained focus on creating a cycle of long-term growth and does not make any changes to tax provisions and leaves neutral impact on more sectors. Nonetheless, he adds, the budget paves the way for stronger macro, supporting equity market sentiment and thus investment case for India.
Okay, let's also get you some money market views this morning. We have Lakshmanan V of Federal Bank, who says that the dollar index remained flat in a data-packed week, with the FOMC and the BOE maintaining status quo on the policy rates, along with the Eurozone PMI and inflation print falling on expected lines. He says the dollar INR traded with a slight volatility as the dollar index and US 10-year yield diverge. He expects the rupee to trade in a range of 82.77 to 83.25 in the next few trading sessions.
This is on bonds. Lakshmanan says that Indian government bond yields slumped sharply. The 10-year posted its biggest single-day fall in 9 months after the interim budget positively surprised the markets with lower than expected fiscal deficit and gross borrowing targets for the next financial year. He says US FOMC was on expected lines. Domestic markets will now shift their focus to the RBI's monetary policy decision due next week. He says coming session could see the 10-year benchmark bond yield trading between 7 to 7.1%.